3 weeks ago in Boston, Massachusetts, on a Saturday morning, the 41-year-old biotech project manager Andre Washington sat at his kitchen table and stared at oil prices on his phone screen. You may remember Andre from earlier in this series. He's the one who discovered 3 months ago that his diversified S&P 500 index fund was actually 38% concentrated in 10 mega-cap stocks. He spent 10 days rebalancing his $487,000 portfolio. He thought he was done. Then the Iran situation escalated. Strait of Hormuz traffic got disrupted. Brent crude jumped from $72 a barrel in February to $119 by mid-April, a 66% move in 8 weeks. Energy stocks surged, tech stocks wobbled, the S&P 500 dropped 4% in 2 weeks. Andre looked at his Rebalance portfolio. Even with the diversification he'd added, his account was down about $19,000 from the peak. Not a disaster, but not the protection he'd expected either. By the end of it, Andre understood 3 specific moves that wealthy investors make automatically when oil prices spike. Moves that almost no retail investor knows exist. I'm Trish, and I sit across from the people who have actually navigated multiple energy shocks across decades. What wealthy investors are doing right now with the energy crisis, the 3 specific positioning moves available to working professionals through low-cost ETFs, and why the standard buy and hold the index advice quietly stops working during oil shocks, you're going to know by the end of this video. Here's what makes this moment so urgent. The US economy hasn't faced a sustained oil shock since 2008. Almost an entire generation of professional investors has built portfolios under the assumption that energy is a small, dwindling component of the modern economy. They were told tech runs the world now. Buy the index. Don't worry about commodities. That assumption was already wrong before March 2026. It is dramatically wrong today. Oil prices have moved from $72 to $119 a barrel in roughly 8 weeks. That move alone has wiped out an estimated $1.2 trillion of stock market wealth in the technology and consumer discretionary sectors. The same move has created an estimated $400 billion of additional value in energy, defense, and commodity-linked sectors. Most retail investors hold portfolios that captured the loss but missed the gain, because their diversified allocation was barely exposed to energy at all. The standard S&P 500 index fund holds about 4% in energy. The standard target date fund holds even less. The average 401k participant has roughly 3 to 5% of their retirement account in energy-exposed companies. When oil moved 66%, the upside protection inside their portfolio was negligible. Wealthy investors do this differently, always have. The 1970s oil shocks taught a generation of family offices and institutional investors that energy needs its own dedicated allocation when geopolitical risk is elevated. The framework has been refined across multiple shocks since then. It's available to any investor with a basic brokerage account and a willingness to act. Today, I'm walking you through Walter's exact 52-minute breakdown. The 3 specific moves, the institutional logic behind each one, and the precise low-cost ETFs that allow working professionals to implement the same positioning the wealthy are using right now. This video is time-sensitive. The wealthy already made these moves. Some of the upside has been captured, but the framework remains available, and the energy situation has not resolved. This is not a stock-picking video. I am not telling you what specific shares to buy. I am not predicting the price of oil next month. I am not claiming insider knowledge of what any specific institution has bought. What I am giving you, a sector-level positioning framework that wealthy investors and institutional money managers have been using for decades when energy shocks happen. The framework is implementable through standard, low-cost, publicly available ETFs that anyone with a Vanguard, Fidelity, or Schwab account can purchase in 5 minutes. The framework is not complicated. It rests on three observations that are well documented across multiple historical oil shocks. Energy shocks reward direct energy exposure. They reward geopolitical hedge assets. They reward defensive cash flow positions. They punish high multiple growth stocks, consumer discretionary names, and over-leveraged consumer credit. Wealthy investors don't try to time the bottom of the shock or predict its end date. They tilt their existing portfolio in the three directions that historically have worked. They rebalance back when the shock resolves. The tilts are modest, 5 to 15% of total portfolio. The impact is meaningful. Move 1. Energy sector overweight through XLE. Walter started with the most direct move. He said, "If you believe oil is going to stay above $80 for the next 6 to 18 months, which institutional investors are currently pricing as the most likely scenario, you need direct energy sector exposure, not 4%, more like 8 to 12% of your portfolio." The vehicle Walter uses, and the one available to any retail investor, is the Energy Select Sector SPDR Fund. Ticker XLE, expense ratio 0.10%. It holds the major U.S. integrated oil and gas companies, Exxon, Chevron, ConocoPhillips, and the rest of the energy stack. When oil moves up sharply, XLE typically moves up significantly. From early February to mid-April 2026, XLE was up approximately 28%, while the broader S&P 500 was down about 4%. A direct energy overweight during the shock would have meaningfully offset the broader market loss. Walter's allocation to XLE is currently about 9% of his total portfolio. He raised it from 5% in late February when the Iran situation began escalating. He's not predicting where it ends up. He's positioning so that whatever happens next is survivable in his portfolio. Then XLE drops too, probably 15 to 25%, but your tech holdings would surge in response because cheaper oil means lower inflation pressure, means easier Fed policy, means tech valuations expand. The two positions hedge each other. That's the entire point. This is the institutional logic. You don't pick. You position so that either outcome is acceptable. For working professionals, adding XLE to your existing portfolio at 5 to 10% allocation provides direct energy exposure that the standard S&P 500 index fund alone does not. The trade takes 5 minutes inside a Vanguard, Fidelity, or Schwab account. Most 401k plans also offer some version of an energy sector fund. Check your plan's fund list. Move 2. Precious metals through GLD or IAU. Walter moved to the second piece. Energy shocks happen because of geopolitical instability. The same instability is the single best historical environment for gold. You need precious metals exposure, not as a primary holding, but as a 5 to 10% buffer. The two main vehicles, SPDR Gold Shares, ticker GLD, with an expense ratio of 0.40%, and iShares Gold Trust, ticker IAU, with an expense ratio of 0.25%. Both track the spot price of gold. IAU is slightly cheaper. Both are highly liquid and trade like any stock. Gold's behavior during the 2026 energy shock has been textbook. From early 2025 to today, gold is up approximately 70%, the highest annual gain in 45 years. Central banks have been buying at record levels. Western institutional ETF inflows have surged. The structural backdrop is one of the strongest gold environments in modern history. Walter holds approximately 8% of his portfolio in IAU. He's held that position for the past 4 years, regardless of short-term price action. The position has roughly doubled in value across that period. He doesn't trade it. He just holds it as the geopolitical hedge sleeve of his portfolio. Andre had never owned gold. The idea of buying gold felt strange. It doesn't produce cash flow, it doesn't pay dividends, it doesn't grow earnings. Gold isn't an investment in the traditional sense. It's an insurance policy. The premium is the opportunity cost of not holding stocks. The payout is what happens to gold when the geopolitical environment becomes unstable. Across decades of portfolio construction, the wealthy have concluded the premium is worth paying. The current environment is exactly when the insurance pays out. Move 3. Defense and Aerospace through ITA. Walter moved to the third piece. This was the one Andre had never considered. When geopolitical conflict drives oil prices, it also drives defense spending. The same dynamics that make energy stocks rise make defense and aerospace stocks rise. The two sectors are linked at the structural level. The vehicle Walter uses, iShares US Aerospace and Defense ETF, ticker ITA. Expense ratio 0.40%. It holds Lockheed Martin, RTX, Boeing, General Dynamics, and the rest of the U.S. defense industrial base. The thesis is straightforward. Sustained geopolitical conflict requires sustained defense procurement. Multi-year defense budgets are funded across both political parties when conflict environments are active. The companies producing missile defense systems, aerospace platforms, and military technology see expanded order books that translate into multi-year earnings growth. ITA is up approximately 14% in 2026 year-to-date through April, compared to the S&P 500 down 4% across the same period. The performance is not coincidental. It tracks the geopolitical environment directly. Walter holds approximately 4% of his portfolio in ITA. He raised it from 2% in late February. His framing: defense is the flip side of the energy trade. Both win in geopolitical instability. Both struggle in peace. I want exposure to both, modestly weighted. The full Andre Rebalance, 2026 edition. Andre's portfolio composition before this second rebalance: 40% traditional S&P 500 index, 25% equal-weighted S&P 500, 20% international equities, 9% bonds, 6% cash. Andre's portfolio after the energy shock rebalance: 30% traditional S&P 500 index, 20% equal-weighted S&P 500, 18% international equities, 9% XLE energy, 7% IAU gold, 4% ITA defense, 7% bonds, 5% cash. The total positioning shift is modest in any single direction, but the combined effect, direct energy exposure, geopolitical hedge through gold, defense sector tilt, meaningfully changes the portfolio's behavior during oil shocks. Walter's portfolio, built across 35 years and adjusted across multiple cycles, looks structurally similar but with slightly different weights based on his retirement timeline. The architecture is the same. The principle is the same. Diversification protects against concentration. Sector tilts protect against specific shocks. Both layers matter. Total cost of Andre's second rebalance, approximately $0. All trades inside his existing 401k and IRA. No tax consequences. Total time investment, about 75 minutes across 2 evenings. That's the framework. 3 sectors, 3 ETFs, 15 to 20% of the portfolio reallocated, 75 minutes of work. The protection runs across the duration of the energy shock, however long it lasts. 3 objections come up here. Let me handle them. Objection 1. Oil might already have peaked. Aren't I buying at the top? Possible. The energy shock could resolve next month. Oil could drop back to $75. XLE could fall 20%. But that's not how positioning works. The wealthy don't time the top or bottom. They hold sector tilts across the duration of the macro condition that justifies them. Energy allocation is 9% right now. If oil resolves and energy stocks fall, his allocation might drift to 7%. He'll rebalance back up to 9%, or he'll let it drift down further if the geopolitical environment de-escalates. The point is not to capture the maximum gain on the energy spike. The point is to have non-zero exposure to a sector that historically pays out when the global economy is in this specific configuration. If you're 4% allocated to energy through your S&P 500 index fund and oil moves another 30% up, your portfolio captures very little of it. If you're 9 to 12% allocated, you capture meaningfully more. Asymmetric protection. Modest cost. That's the entire trade. Objection 2. I don't have an IRA or brokerage account, just a 401k. Can I still do this? Mostly yes. Most 401k plans offer something in each of the three categories. For energy, most plans have a real asset or natural resources or energy sector fund. Check your plan's fund list under sector or specialty options. For gold, direct gold ETFs are rarely available in 401k plans, but most plans offer some kind of real asset fund that includes commodities and precious metals exposure. Vanguard's Total World Stock Fund has minimal gold exposure but isn't a true substitute. If your 401k doesn't offer direct gold, consider using your IRA or HSA for that allocation instead. For defense, pure defense sector funds are uncommon in 401ks, but industrial sector funds, which include defense contractors, are widely available. Objection 3. Isn't this just market timing? Aren't we supposed to buy and hold the index forever? The buy and hold the index advice originated when the index was actually diversified across hundreds of companies and multiple sectors. As we covered in the Goldman Sachs warning video earlier this series, today's S&P 500 is heavily concentrated in 10 mega-cap tech companies. Buying the index today is a concentrated bet on tech, not a diversified bet on the US economy. What I'm describing here is not market timing. It's maintaining the diversification the index used to provide on its own. Sector tilts of 5 to 10% across a few specific exposures are not stock picking. They're structural diversification that the modern index has stopped providing. The wealthy don't abandon index investing. They use index investing as the core, 60 to 70% of portfolio, and supplement it with sector tilts, 15 to 20%, that fill the diversification gaps the modern index has developed. The cash and bond positions, 10 to 15%, round out the structure. That's institutional asset allocation 101. It's the same thing pension funds and family offices have done for decades. The DIY version available through low-cost ETFs is the gift of the past 20 years of financial product innovation. Working professionals can build portfolios that look structurally similar to a $50 million family office portfolio. The architecture is the same, only the dollar amounts differ. Action steps. 3 steps. This week. Each one moves money toward the same diversification framework wealthy investors use during oil shocks. Step 1. Tonight, the current allocation audit. Log into your 401k, IRA, or brokerage account. Find your largest holdings. Write down the percentages. Identify your current exposure to energy sector, precious metals, defense sector, international equities. For most retail investors, the answer is approximately energy 3 to 5% through index funds, gold 0%, defense 0 to 2%, international 5 to 15%. If your numbers look like that, you're in the standard configuration that historically has captured oil shock losses without capturing oil shock gains. The next 2 steps fix that. 15 minutes tonight. Step 2. This week. The 3 ETF research. Look up the 3 specific ETFs in your existing brokerage or 401k platform. XLE, Energy Select Sector SPDR. Confirm it's available. Note current price. Read the fact sheet, 1 page. IAU, iShares Gold Trust. Confirm availability. Note current price. Read fact sheet. ITA, iShares US Aerospace and Defense. Confirm availability. Note current price. Read fact sheet. If any of the three is not available in your 401k, identify the closest available equivalent. Most plans have something in each category. If your IRA or brokerage account has these ETFs, that's your primary implementation channel. 20 minutes this week. Step 3. This month, the execution: allocate 5 to 10% of your portfolio to XLE for energy exposure, 5 to 10% to IAU for precious metals, 3 to 5% to ITA for defense. Total tilt: 13 to 25% of your portfolio, sourced primarily by reducing your traditional S&P 500 index fund holdings, which are already concentrated in tech sectors that struggle during oil shocks. For most investors with $100,000 to $500,000 portfolios, the actual dollar amounts are $5,000 to $25,000 per allocation. The execution takes 15 to 30 minutes inside any standard brokerage platform. Most plans charge zero commission on ETF trades. The energy shock has not resolved. The framework is still actionable. The wealthy already moved. You can still move now. If this video helped you, or if you've watched the recent oil price moves and felt your retirement account moving the wrong way without knowing what to do about it, do me one favor. Hit the subscribe button. New video on this channel every single day. Each one is a specific move that puts real money back in your pocket, same way this one just did. And here's what's coming tomorrow that affects every American currently in their 30s. There is a specific 10-year window in your life, between approximately age 32 and age 42, where the financial decisions you make compound across the rest of your career. Decisions made during this window are dramatically more impactful than the same decisions made 10 years earlier or 10 years later. The math is brutal. A specific savings rate increase at age 33 produces roughly 4 times the retirement wealth as the same increase at age 47. A retirement account opened at 31 instead of 41 typically ends at retirement with double the balance. The window matters more than almost any other factor in your financial life. Tomorrow, I walk you through exactly what the 10-year window is, the 5 specific decisions that have to happen inside it, and the catch-up framework if you're already past it. Because for most people, the window is closing, not opening. If you are between 28 and 45 right now, tomorrow's video is the most important one in this series for you. I'm Trish. Talk to you then.